Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi all, first webinar is on Once Upon a Portfolio, Lessons from Behavioral Finance. So this webinar is happening this Saturday from 10 AM to 11 AM. Second webinar is on Power of Habits. So this is happening from 11 AM to 12 PM and it's an only exclusive women only webinar. Third webinar is on Navigating the Investment Challenges and Rewards of Good Investment Behavior. This webinar is happening on 11 AM to 12 PM this Saturday. The fourth webinar is on Is it a time to panic and how long will the market corrections last? So this webinar is happening from 12 PM to 1 PM. All the registration links are given below. Please do register. Thanks.
Let's take a quick pulse check on how the market is feeling. We're a few weeks into 2025 and already the sentiment is quite different from how 2024 was. So what's going on in the market? Why has the mood changed so much? Let's look at a few data points that could guide us as to what is actually happening and what are some fears and sentiments that are prevailing over market participants today. The first and possibly the most important data point that we are going to look at is how FIIs have been behaving in the Indian market. If we look at the behavior of FII investors, they have been net sellers for almost every single day in 2025. And if we look at how much they have sold, this amount is 46,500 crores. With FIIs selling a lot of Indian investments, what you're actually saying is, one, that they're more conscious about India valuations. Two, that they are finding global opportunities to be more attractive than Indian opportunities. Broadly, what you're seeing play out is the fact that there is a lot more confidence in the US economy and in the US markets, which is why you're seeing money flow out of emerging markets into US markets. The next trend that we need to look at is inflation, because inflation has been front and center of a lot of monetary policy decisions over the last 5 years. So of course, during the COVID phase, you had a lot of attention on keeping the economy on track, and then you had your inflation problem which spiraled out of control, and then central banks have been able to move that needle closer to the targets that they want to achieve. As we rolled out of 2024, there was a lot of fear as to how inflation would affect economy and markets in 2025, primarily because you were still seeing numbers that were outside comfort zones for central banks, whether it was the US, whether it was India. But if we look at the latest prints that came out in December, then there is something of a relief that market participants are feeling, because you're seeing those inflation numbers over 3 or 4 months move closer to their target. So if we look at where US inflation, that is your CPI numbers for December stand, that's at 2.9%. and that's a 3-month low. If we look at where India CPI numbers stand, we are at 5.22% and that's a 4-month low. So clearly there has been some shift towards a more normal level of inflation, even though we're not at the target of say 2% for the US or 4% for India. There's still a long way to go, but you're making progress in the right direction. So this again gives market participants some sort of confidence that okay, maybe there can be rate cuts in 2025, especially if this whole inflation thing plays out exactly as expected. In the US, you would also need to look at labor market data and see if job growth, etc. is slowing down, because that would again warrant a rate cut. In India, we have a lot more progress to make towards our normal inflation numbers. We're also expected to grow at a reasonable rate. We could be doing better, but it's not that we're a slow economy at this point. We're slowing down from a heated level. The third element of the mood check that we're going to do is about how the indices are performing. So one thing that we need to be very clear about is that the index is not actually painting the true picture of what's happening to different companies. When we look at the index level moves, they actually kind of mute what is happening to individual companies within the index. So as an investor, if you are looking at your portfolio, you're probably dealing with a lot more volatility than what the index is actually showing. So your own portfolio might be falling 10%, 15% on a given day, whereas the index may only be moving 1 to 5% down. So index investing is actually not giving you a pulse check as to how markets are. At the same time, the opposite is also true. If the index is falling, there are individual stocks that are gaining quite a bit, and this shows us that markets are significantly more volatile than what the index is showing you. So an investor actually needs to prepare for this volatility and use this volatility as an opportunity to strengthen their portfolios. This brings us to the fourth element that we're going to consider. And before we get into what that is, I'm going to quote Morgan Housel, and he said that risk is what you don't see. Now, this is a very interesting way of looking at things, and it also allows us to put on our contrarian hats and think as contrarian investors, what is it that we're not actually seeing in the market, and where can this invisible risk sort of arise from? So the first thing that we hear a lot from investors is that, in all of this, the large cap stocks are the ones that are falling. And we need to think beyond that obvious observation that we have, which is that large cap performance has been negative. Just because a stock is falling, does it mean that it's actually a riskier investment to hold? This is something we need to think about. At the same time, we are seeing other indexes and other funds, let's say in the mid and small cap segment, where the fall has not been so pronounced, and an investor might be thinking that these are actually safer parts of the market because the fall hasn't been so pronounced, and despite all the bad news, these stocks are holding up. So when we have these kind of thoughts, we need to think more deeper and one level further to see where the risk actually is. Because risk is not always measured in performance. The risk is measured in things that can lead to underperformance or long periods of no performance. The last element of the mood check that we're going to look at is how moods change very gradually and sometimes swiftly. So when I'm talking about a mood shift, what tends to happen is you'll have certain sectors, themes or asset classes which are in favor, which are in high favor in certain points in time, and then because they don't deliver the kind of expected returns, you see them move out of favor. So there is a rotation amongst sectors, there is a rotation among themes, there is a rotation among asset classes that an investor needs to be more aware of. As this rotation is happening, an investor needs to shift their portfolios and rebalance them correctly. If an investor waits for the rotation to happen, then they're always going to be chasing performance. And when you chase performance, you're going to be disappointed because your results are not going to look as good as the results that you've seen so far. So there's an imminent need for investors to reposition their portfolios. There are many ways that you can do this. You can reach out to your financial advisor. You can reach out to another finance professional and get a portfolio review done. This is our reading of how the market sentiment is. What is your reading? Let us know in the comments below.